Welcome to this webinar on finding winning stocks, a simple strategy for high-quality stocks at non-bubble prices. So this talk will be of interest to you if you find yourself checking the price a bit too often, if you overtrade at the worst possible times, if you don't know what to do when and when to do what. I think you'll get a lot of value out of this. First, a disclaimer. The fine print, please read through this, but the TLDR is this is not financial advice, it's for educational purposes. Here's an outline of what we'll cover, the pixelated truth of investing. A simple strategy for stock picking, what's a good company, what's a good value. We'll fill in the trading quadrant for how to find winning stocks. We'll talk about how to buy low hype and sell high hype. And as a bonus, cover some tools for your own wealth building journey. So a bit of background on me. My career spans the ivory tower. I have a degree in applied math, PhD in theoretical physics. Silicon Valley, I started an energy company using nanomaterials for energy applications. And the finance world, I worked as a research analyst and investment writer, worked on the portfolio team of an 11-figure fund focused on innovation and new technologies at a $1 trillion asset management firm. And from that experience, I wrote a book, Stop Checking the Price, where the idea is to simplify the complexities of finance through intuitive thinking, not using complicated models. So let's get into it. The stock market equals information overload. This is what you can imagine traders looking at. A bunch of screens, red and green lights flashing, bells going off, the price of oil, the price of gold, whatever Elon is tweeting today. So much of it is just noise. Information that we don't need for long-term investing. And in the book, we call this the pixelated truth. You could understand it by looking at this apple here. Very clearly, it's an apple. But if you wanted to become the expert on the apple, you might think, well, let me zoom in. Let me try and understand the details. But the reality is, because information has mathematical limits, the more you zoom in, the more you're looking at just a blurry pixel. And by being the expert on all of the blurry pixels, you're not actually more informed about the apple, and in particular what the apple's going to do tomorrow. And so the analysts who spend all their time consuming this information, steeped in the noise, they're not actually learning more and being able to make better predictions about a complex marketplace. That's the pixelated truth. Take a step back, zoom out, and simplify. Now, how do we know this is true? Well, look no further than Wall Street and common predictions every day. Here's Jim Cramer. It's way too early to expect the stock market to rebound. This is a tweet from September 2022 where he made this prediction. So let's hold him accountable. Let's see what the stock market did a year before and a year after his prediction, here shown in red. We may need to see a lot more red, he says, perfectly calling the bottom. The stock market turned around and went up and has since continued its run. And so Jim Cramer called it 180 degrees in the opposite direction. Wall Street's predictions suck, just like everyone else's predictions. So be careful of the experts, be careful of the narratives in the news telling you what's going to happen tomorrow. But nonetheless, this doesn't stop Wall Street and Wall Street's business model of taking fees off of our money, and those fees that compound and grow with time as our money compounds. So what we're trying to do is turn this on its head and educate individual investors on how to find high-quality companies at reasonable prices. So how can we do that? Well, let's listen to the granddaddy of value investing, Warren Buffett, the GOAT, who's been doing this for the past 200 years, the expert. And he summarizes it nicely, paraphrasing him here, just buy good companies at good prices, am I right? So let's try and follow this simple philosophy. I'm putting a book here, The Tao of Capital. I reference this in Stop Checking the Price. It's written by Mark Spitznagel. He's a hedge fund manager, and he really lays the foundation for this strategy. So here's the trading quadrant. We're going to break it down, good company and good price, into this 2x2 matrix. But before that, let's talk about the first law of investing. Avoid large losses. Sounds obvious, but if you look at the logarithmic curve, you can see that the math puts a sharp point on this. Large losses hurt us more than large gains help us. And we can see this mathematically. So a 10% loss requires an 11% gain just to get back to where you started. A 20% loss requires a 25% gain. A minus 50% loss requires a 100% gain. Minus 90% requires a 1,000% gain just to get back to where you started. And with 100% loss, it's game over. And so the point here is that it's not important to find that winning lottery ticket. What's more important for long-term compounding is protecting ourselves from the risk, from the downside, from those large losses. And so combining the first law of investing with the pixelated truth, we have a filtering strategy. There's an expression, one rotten apple spoils the whole barrel. And so if we think of the barrel as the stock market or our portfolio, the apples are the individual stocks. And what we want to do is quickly throw out the easy to identify bad apples, those rotten apples, rather than spending lots of time searching for the best apple. Now in that process, we inevitably throw out some ripe apples too, but that's okay, because we can inspect every detail. We don't care about how firm the apple is, how ripe, the notes and the flavors, trying to find that perfect apple. Instead, let's get rid of the rotten apples fast, and whatever's left over is good enough. You could think of this like the 80-20 rule. The 80-20 rule says that we can get 80% done in 20% of the time. And if you extend that, you'd find you can get 50% done in 1% of the time. And so we're saving 99% of our time to still get 50% done. Now you can't outsmart this law. You can't get 150% done in 3% of the time because of diminishing returns. But hopefully the idea is clear. Let's move fast. Let's move the needle. Let's get rid of the rotten apples as soon as we can, and then with whatever's left over, we can continue our analysis. So what does that mean for the trading quadrant? Well, let's get rid of the rotten apples. Bad company, sell. But what's good company and what's bad company? So in the simplest sense, a good company is a money printing machine. A little more accurately, a good company turns capital, equity and debt, into big profits. And so we have $100 here, invested capital. Let's put it into our money-making machine, this beautiful cardboard box. That's our business. And what does the business do? By operating, it spits out profit. So we have a yearly profit. So $100 comes in to the cardboard box, our business, and it spits out $50 each year. And so with this, we can form a ratio. The return on invested capital, ROIC, our most important quality metric. And so it's that profit, so let's say $50 divided by that invested capital. So that would be like 50%. Now this isn't the whole story, because to raise that invested capital, we needed to go to our shareholders, our investors, or our debt holders, the bank, to get that money, to raise that capital. And that has an associated cost, the cost of capital. So shown here, let's say it's $10, for example, a 10% interest rate if we're using debt. And so from that cost of capital, we can form the WACC, the WACC, the weighted average cost of capital. And in this example, that would be $10 over $100, so 10%. And putting these two together, we have our definition of a good company. A good company is creating value. The ROIC is greater than the WACC. And so in this example, we had a 50% ROIC, and that's greater than the 10% WACC, the 10% cost of capital. Let's look at an example here. So here we see Google, the ROIC in green and the WACC in orange. And what we notice is that the ROIC has been steady above the WACC for a long term, and it's been increasing. That's what we want to see. So we want our ROIC to be high, steady, and increasing, even as the business is growing and we're investing more capital. That's the sign of a great business. So now we can fill in our quadrant here for good company and bad company. A good company is creating value, bad company is destroying value. Now, there are other metrics that we can explore, such as gross margin. So gross margin is the percentage of revenue that's left over after taking into account the cost of that revenue, the cost of your goods and services sold. High gross margin correlates with pricing power, having a moat, being inflation resistant. Now, it's not always the case. There's no perfect metric, but it's more support for the quality of the business. So we can see with two examples here. On the left, we have Facebook, Meta, the gross margin, and on the right, we have ExxonMobil. And so we could see for Meta, gross margin 70 to 80%, very high, a software business with a walled garden, billions of daily active users. And then we have Exxon on the right, selling oil being a commodity. And you could see gross margin has been coming down for decades, now below 25%. And so it's a simple metric that again supports the quality of a business and that moatiness. What about growth? So at the end of the day, we want our businesses to grow. And so there's an expression, you can't cut your way to growth. No matter how efficiently you run your business, if you're not bringing in new money and increasing revenue, your top line, your sales, then you can't cut your way to growth. And so what we're plotting here is the quarterly revenue, on the left for Amazon, on the right for Walmart, and notice that it's on a log scale. So on a log scale, a straight line corresponds to exponential growth. And we could see Amazon over decades has maintained that exponential growth, only now maybe starting to flatten over after crossing 100 billion quarterly revenue. Walmart, you could see, started to roll over, not quite a straight line there, flattening out. But this is no surprise. If you're making 100 billion quarterly revenue, it becomes more and more difficult to find new sources of revenue to sustain that growth. And so by looking at revenue, we could see from the top line how the company is growing, and by plotting it over the long term, we can very easily visualize these key trends. So let's put high quality to the test. Here we're looking at real historical data to see how a simple strategy would have performed. This is the growth of $1 invested in the S&P 500 over 30 years, that's shown in red as the dotted line, and a simple strategy, taking the S&P 500 companies and filtering down by ROIC greater than 30%. And so we do this every year. We apply our filter and we hold the companies for a year. Don't touch them, and do that for 30 years straight, and you see this result, turning $1 into nearly $80. And so over this time period, 30 years, we do 15.6% annual growth with this simple filter. That's 5 times the S&P 500 over 30 years. Now, we can't predict the future. We saw Jim Cramer. But going through wars, pandemics, housing bubbles, tech bubbles, hype, fear, speculation, panic, and still outperforming the market over the long run, this shows that high quality wins the long game. Now, what about value? So what's a good value? Well, let's start with this cardboard box here and a $100 bill inside. If I asked you, how much is this box worth? Well, you might say $100, ignoring the cost of the box. But what if we had instead a box that spit out $1 every day for 100 days? Is that box worth more than $100, less than $100, or exactly $100 right now? And so according to Finance 101, the value now is equal to all of the future value this box will spit out, discounted by the value of time. A bird in the hand is worth 2 in the bush because you have to go search the bushes. That takes time. And so if this box is spitting out $1 every day for 100 days, it's actually less valuable than the $100 right now because we have to wait for those $100, and that costs us time. It's an opportunity cost. And so as a result of this, we can write down a beautiful equation. This is the equation for net present value. And it's saying the value right now is equal to all of the future cash flows until the sun burns out, until the universe ends, adding up all of the future value that will be generated and dividing by this value of time, this discounted rate. And so this is a simple equation we can write down if you want to start a new company, if you want to buy a stock, if you want to build a factory, a power plant. You can use this equation, this magical equation. But just because we can write it down doesn't mean it's going to be accurate, because we have to predict the future. So just being able to write down an equation that says what's the value of anything doesn't mean we know what's going to happen tomorrow. Look no further than Silicon Valley Bank. So here's Silicon Valley Bank share price right up until the crash. There are analysts working every single day, full time, doing discounted cash flow models, trying to piece together price targets for all of the stocks out there. And here's what happened. Goldman Sachs maintains buy on Silicon Valley Bank with a price target over $300 literally weeks before the collapse. And so even the experts, even the analysts doing this full time can get it completely wrong because we can't predict the future in a complex marketplace. So where does that leave us? Well, there's many roads to valuation. We just talked about how to value a share. You add up all of the future cash, properly discount it. But there's other ways. We can compare apples to apples. So for example, comparing multiples or ratios like the price to earnings ratio, price to book, EV to EBITDA, free cash flow yield. There's a bunch of ratios that we can write down and then try to compare different companies as their peer groups or in their own industries. But what we're going to talk about is Austrian Economics 101 using the Tobin ratio, Tobin's Q ratio, or also called the replacement cost. I like to call it the hype factor. And what it is this value Q, which is the market assets, the market value of the assets divided by the replacement cost of the assets. So if Q is 10, would you rather pay $10 to own the company that controls the assets, which are only worth $1? Or would you rather go and pay $1, control the assets yourself, and reproduce that business model, replacing the company? That's what Q is telling us. And so we have one box here, and we're measuring the replacement cost of that box. And so like a hype factor, when Q is very high, the company is hyped up. And when Q is very low, The company is unhyped. And so we can have a Q star, which is like an equilibrium value. This is technically the median Q, but over time it gives us an equilibrium value of the market's historical valuation using this metric. So let's see an example. So here's the long-term Q, but for the entire stock market. This is going back to 1900, so 100 years of data. You see it's not quite at 1, even though that's the theoretical value for the replacement cost. It oscillates up and down through hype, fear, panic, stock market bubbles. And what we can take away from looking at these oscillations over time is that the stock market is emotional. It's irrational. It's inefficient. And all of that together, all of these hype fluctuations create an opportunity for us. We can use hype and be on the right side of the equation to create value for our portfolios. But don't take my word for it. Listen to the experts. Warren Buffett, be fearful when others are greedy and be greedy when others are fearful. Bill Ackman, you make the most money when you buy the unloved and sell the overhyped. So let's listen to the wisdom of the experts. Keep it simple. Buy low hype and sell high hype. So now let's return to our quadrant and incorporate this. We have our undervalued and overvalued conditions for when this hype factor is below the equilibrium and overvalued when it's above the equilibrium. Now, if we have a good company that's undervalued, that's a buying opportunity. But what about a good company that's overvalued? Well, that's a trim. We may not want to sell everything, but we do want to take some risk off of the table. As the traders say, cut your losses and let your winners run. So that's our trim there. Why? Well, remember the first law of investing. We want to avoid large losses, and in particular, avoid bubbles, because when bubbles pop, they hurt. So that's why we can trim, and that fills in our quadrant. Let's take a look at an example of actually applying this. So why should we not invest based on the nonsense news? Facebook presents a great example. Here's a tweet from September 2022. Mark Zuckerberg is continuing to derail Facebook, says a Harvard expert. He's really lost his way. And so if you were listening to the nonsense news and the hype, you might sell Facebook because the Harvard expert says so. But now here's a plot of the hype factor in green and the equilibrium hype in purple for Meta. And you could see this was 2022. Facebook wasn't getting a lot of love, Mark Zuckerberg being attacked in the news, and yet the company fundamentals remained strong. And so if you were looking at this hype way below equilibrium, you would say this is a massive discount. And if you got in here 2022 around $200 and you held through crossing the equilibrium hype, 485, that's 129% annualized gain. So Zuck is happy. Don't listen to the nonsense in the news. Buy low hype and sell high hype. Let's see another example. Here's Google. So you can see the hype factor was oscillating up and down, staying around that equilibrium value. But then post-COVID took off. And so hype grows above the equilibrium value. That's where you may want to sell. That's where you may want to trim. Gets up to 145. And so you might say, well, this is a little hyped up for me. Sell out. And then comes crashing down. And so the hype drops below equilibrium, $88. You might want to get in there. That's a buying opportunity. And then goes back up over equilibrium. And so again, you may want to trade. And so this is just showing how hype oscillates even though the long-term equilibrium is steady. And we could use that to our advantage following the wisdom of the experts. Let's look at one more example. Here's Ferrari, ticker RACE. And so we can see that the equilibrium hype was around, let's say, 5.5 in 2022, and yet the hype factor dropped below. And so that presented a buying opportunity. Get behind the wheel of this stock, 182, going up in less than 2 years to 433. So that's a 78% annualized gain. And that's the type of acceleration that I can get behind. Buying low hype, selling high hype for high quality businesses. And so we saw a few examples that put the pieces together following the trading quadrant. But to summarize, here's what we learned. Avoid information overload. Even the experts can't predict the future. Check long-term data. Don't get caught up in the short term in the emotional news hype of the day. Look at the trends over the long term. Follow the first law of investing and avoid large losses. Filter out those rotten apples and avoid bubbles. Filter stocks by 2 simple quality and value metrics. We saw our key quality metric, a key value metric, and put those together so that we can throw out these rotten apples. Now, there's a lot of apples out there, and being able to use these key metrics, again, following that 80-20 rule, we can simplify, filter out the noise, and quickly find these winning stocks. And the last one, high quality stocks at non-bubble prices win the long game. That's backed by the research, it's backed by the data, and the wisdom of the experts says it because it works. So I'll leave you with this quote. The best time to plant a tree was 20 years ago. The second best time is today, a Chinese proverb. I would add a twist on this. The best time to start compounding was 20 years ago, and the second best time is today. And so with that, let me plug our tool. If you liked the way that we did this analysis, if you liked these quality and value metrics, and you like quickly analyzing stocks to find the winners, please go visit valueglance.com. You can get a 7-day free trial. We have a free tier that you can test out. You can simply analyze any stock that you want, see these long-term trends, and we even have a screener in there so that you can filter thousands of stocks to find those value creators and get in at non-bubble prices. Coming soon, we're going to have a back tester so you can actually test out your strategy over decades of real historical data to show market-beating returns. If you want to dive deeper into the research and the historical data, please check out the book, Stop Checking the Price. It's available on Amazon. And if you want to stay in touch with our investing content, please sign up for our newsletter, Compound Knowledge, latest investing, trading, and wealth building content so that we can all compound knowledge together. So with that, I thank you and wish you good stock hunting. If you want to follow us on social media, we're at ValueGlance. And don't be this guy. Don't read the nonsense news. Don't get caught up. Think for the long term, high quality stocks at non-bubble prices to win the compounding game.